What is implied skew? Have you ever wondered why some options seem to have higher prices than others, even if they are for the same underlying asset? This brings us to the concept of implied skew. Implied skew, also known as volatility skew, refers to how implied volatility varies across options with different strike prices but the same expiration date. Implied volatility represents the market's expectation of future price fluctuations of the underlying asset, and it is reflected in the price of options. In practice, implied skew shows that not all options are priced with the same implied volatility. For instance, in stock options, out-of-the-money puts often have higher implied volatility than at-the-money or out-of-the-money calls. This creates a skewed volatility curve that typically slopes higher for lower strike prices. This indicates that the market is pricing in greater risk or demand for protection against downward movements in the underlying stock. The skew can take different shapes. One common shape is called a volatility smile. This occurs when implied volatility is higher for both deep into money and deep out-of-the-money options compared to at-the-money options, resulting in a U-shaped curve. Another shape is known as a volatility smirk, which shows higher implied volatility for out-of-the-money puts compared to out-of-the-money calls. This reflects a greater demand for downside protection. Implied skew arises from various market factors, including investor sentiment and the supply and demand for options. Investors often buy out-of-the-money puts as a form of insurance against sharp declines, which pushes their implied volatility higher. Traders analyze implied skew to gauge market sentiment and develop trading strategies. For example, they might look at the difference in implied volatility between puts and calls at the same delta, which is a measure of how much an option's price changes relative to the underlying asset's price. Changes in skew can signal shifts in market expectations or risk appetite. In options trading, understanding implied skew is important for volatility trading strategies. It helps traders identify mispricings and opportunities to trade relative value between options at different strikes. It also informs hedging decisions by highlighting where the market anticipates more volatility or risk. In summary, implied skew is the uneven distribution of implied volatility across strike prices of options on the same underlying asset. It reflects market perceptions of risk and demand for protection, especially on the downside. This concept plays a significant role in options pricing, trading strategies, and volatility analysis.